Right, everybody, welcome to Brighter. So today we're going to do a deep dive review on a report that Deutsche Bank released a couple weeks ago. Emmanuel Rosen, investment analyst, met with Tesla and they were able to review quite a number of information. They talked about the Q3 expectations, Austin and Berlin factories, the new Model 3, the Cybertruck, of course, the pricing strategy, the next gen platform, FSD and Dojo. And for each of those, we actually have information that only this investment analyst was able to get and us retail investors weren't able to get. So today we have Jeff Lutz joining us. Jeff is an ex-supply chain and C-level executive. He worked at Motorola, Google, and Lenovo. He's currently has his own consulting firm for serving mega cap tech companies. Welcome, Jeff. Thank you for helping us figure all this out.
Great to be with you.
All right, so let's go through this. There's a lot of really good nuggets that came out of this. Just blown away by the information that they were able to share. So this is the report. We're going to share with you line by line some of the key information. This came from Deutsche Bank, Emmanuel Rosen. And the first thing they did was they said it's a buy. They're going to do a raise of the price target to $300 from $256. Some of the information was that they actually hosted an investors meeting with Tesla. This was 2 weeks ago as part of Deutsche Bank's Cars conference in conjunction with the Munich Motor Show. And they had quite a bit of information. So Jeff, why don't you start off by just telling us, the information that these investment analysts can actually gather that's really specific that others like us can't get.
Yeah, I mean, they sat down with the management team, I think in Berlin, and went through just really every facet of where the company is working on. And, they went into this obviously with a lower price target and emerged with something significantly higher. So it sounds like they had a really good discussion. Some of the information that they're able to gather and publish as a basis for their analysis, I think is really interesting. I think it answers a lot of the questions that have been out there, in the investment community. So it's a really unique look into kind of both Tesla tactically as well as in the medium and long term. So looking forward to going through it.
Okay. Let's start off with Q3 volume and margin trajectory. This is what they learned by talking to Tesla. So first, Tesla clarified that production and volume will be down in Q3 sequentially. We already knew that. In Q2, company had 16 days of sales inventory, mostly in transit. You've been talking to us about that, but it's not enough to offset production impact from shutdowns happening in Q3. So that's interesting information that we hadn't heard yet. And then this is interesting. With volume down in Q3 and bulk of raw materials taking place in Q2, the biggest cost reduction opportunity would be the continued ramp up of Berlin and Texas. So why don't we stop there and you explain all this?
Yeah. I think it's good for them to kind of get the Band-Aid ripped off a month before the quarter ends. Tesla's been really working on that, reducing that delivery wave in the last months. They must have a pretty good understanding of how they see September and the quarter ramping up. So when we had the earnings call in the third week of July, Elon and Zach were very clear of look, we're doing these factory upgrades. Production's going to, probably be slightly lower than it was the prior quarter. We get through these upgrades, and the factories come out stronger, better. They did not, though, indicate that deliveries would have been, but it looks like, and I think this is a really important topic to spend a minute on, and what I've been harping on with inventory. When you hear people on Twitter or even in YouTube videos that talk about inventory that have never run a factory or run an operation end to end materials, the full supply chain, you're going to get a lot of really bad information about inventory, especially with these trackers that are out there. You're going to hear terms like highest inventory ever, or it's up, 3 days in a row, or whatever. You just go through the list of multiple choice things you've heard about Tesla inventory. But what you've heard basically for most of the year is that when inventory goes up, they've got to make pricing moves. Inventory is higher than it's ever been before. And what Tesla went through there was something really important and fundamental. So there's basically inventory in three major different forms. It's in the raw material form, which would show up on the balance sheet most likely. Then there's the finished goods that are that are in the factory, and then there's finished goods in transit, and then there's finished goods in channel. And I want to just break this down for a quick minute, so everyone understands what was said in this piece. So I've always thought that, okay, when I saw the 16 days of inventory, it's up maybe from 13, and then from a year or two ago it was single digits. I've always thought that Tesla was undersupplied, that they were stocked out in areas, they just didn't not have enough inventory, and it would just be insufficient. I would not be even remotely concerned about Tesla inventory unless it got well north of 21, 23 days of inventory. And even then, it's still industry leading and in great shape. So what Tesla told Deutsche Bank is like, look, we have this 16 days leaving, but half of it is basically in transit, which means it's built and on the way to fulfill an order that a customer already has. So it's not like it's sellable inventory. Then the other 8 days is basically it. So if Tesla's, just, pick your number. If Tesla's building 7,000 units per day, right, depending on if you use a 75 or 90-day production calendar, 70,000, and if they have 8 days of sellable inventory, that's less than 60,000 cars in the world. So, what this, I think the key takeaway here is Tesla did not have enough inventory, even though it's quote unquote the highest ever. Remember, everybody's trying to scare you about inventory, highest ever. They did not have enough inventory to cover, call it a 10 to 12 day or so shutdown in each of these facilities to do the upgrades. And that to me makes sense. They're going to have to build up additional inventory. And in fact, in Q4, I think they're going to have to build up significant inventory. I think Q4 will hopefully be a record production quarter, so they can prepare, at least in North America, for the IRA. And then in the rest of the world, to relaunch this Model 3 refresh and get it into distribution. So in summary, I love the way they broke down the fact that the 16 days is insufficient. Half of it's in transit, which means it's not sellable for consumers. That 8 days remaining of inventory, that means there's stockouts everywhere. You basically can't go in anywhere you want and buy a Tesla. So I thought that was a really important takeaway.
Okay.
And then the third point, sorry, Herbert, on the cost reductions. Sorry, I spent a little bit of time in inventory, but on the cost side of it, part of that has always made sense to me is that a lot of the inventory they would have to move in Q3 would have been stuff built in Q2, where they already took a bulk of the cost reductions. I still think that they've got more work to do, and it's better for them to not overcommit to analysts and under-deliver, but it may not be coming from the commodity side. In fact, commodities have been going up in the last, several weeks, but Tesla does not pay spot pricing for all of these commodities. They've got long-range contracts. So what I think is difficult for Tesla to call in Q3 is I think most of their cost reductions are going to come from ramping the lower cost Model 3 and also getting more efficiencies out of their most inefficient factories, which are Berlin and Austin. And that's going to be difficult for them to call this early on in the quarter if they're going to be able to pull out all those efficiencies. But if they do, I think they can have some significant cost reductions still in Q3.
Okay, continuing on Q3, there are just so many good nuggets here. It's amazing. I was just shocked. So the next one is the potential for more meaningful cost lever from Berlin and Austin factory will be in 2024. Mm-hmm. So that's where the expectation is not going to happen in 2023. And then they did talk about the lag for the raw materials. So it typically is a few months, but they say that Tesla's benefit is likely to be muted. So the company didn't see a large impact from raw materials inflation. It certainly would not benefit greatly during a deflationary environment. So that's interesting. And then the final thing is that, despite all that, the company's still comfortable with its target to reach 1.8 million delivery volume. So yeah, any comments on this?
They're saying they're going to have a big Q4, is what they're saying. And everything else I agree with in terms of Berlin and Austin. I still think they're going to make meaningful progress. I think there's many thousands of dollars of inefficiencies when you're not fully utilized in the factory per vehicle. And if you just put this in context of, if you think Tesla's average COGS for 3 and Y are in the mid 30s, you're talking 3 to 10% maybe per vehicle that still could be out there in terms of opportunities between Berlin and Austin. So I think that's where they're going to get a bulk of the reductions. I also think they have these things called event-driven reductions, where they're either going out to a supplier and they're making a change on a part to reduce cost, or they're making a change in one of Tom Zoo's gigafactories, either engineering driven or Tom Zoo driven, to simplify a process, eliminate a part, or eliminate some sort of process in the factory. And then finally, Tesla is still keeping their suppliers fully utilized, so they can go to their suppliers every quarter and say, look, I need 1% out of you. I need 1.5% out of you. 1.5% is basically the minimum in terms of what they should be getting out of their suppliers from a COGS perspective every quarter. I think they've been doing I thought they did much better than that actually in Q2. So I think there's still a number of areas of opportunity. I think they're undercalling the opportunity in this note.
Yep. And this is reflecting what you just said now. Let's go through it. So this is the Austin and Berlin factory ramp. Again, quite a number of information here. Let's break it down. So the first thing they say is that the manufacturing costs for Austin and Berlin are improving, but still above Fremont at present. So the costs are still above Fremont. So they still need to work. But a big piece of the manufacturing cost reduction will happen after the ramp is done and production stabilizes. So they have not even worked on the cost yet at this point. And then they reiterate that once Austin and Berlin reach more stabilized production level, they will then be able to implement cost efforts, and this will be larger time frame. So this explains a lot of what we were saying, which is that we were all waiting for Austin and Berlin to scale. They're now at 5,000 per week, but they have not yet even got the cost experience yet for us, valued for us. But that means it's good news for the future. Thoughts on this?
Yeah, I think some of this is 4680. I think the inflow of the 4680 has been lumpy. When you have lumpy inflow of materials, that means you're getting these spurts of decent size input material, and then you're going down, and then you're getting these, and then you're going, and that's terrible for the COGS structure of the factory. So, and that's why they're building non 4680 as well in Austin and Berlin, actually, to stabilize that. So I think the 4680, both its own cost structure and then its inability to be supplied, with a consistent flow at the volume and rates that are needed. And by the way, now they're probably having to squirrel that away for Cybertruck, for the Cybercell. I think that's been a big portion that's been blocking Berlin and Austin, Austin, and then most likely Berlin from achieving this. So achieving production stability. So I think they got to get the 4680 stabilized. I think they've got to get and then from there you can stabilize the workforce, you can stabilize the production lines, and then in Austin you're still going to have Cybertruck ramping, which is going to be it's going to be unstable. You're going to have lots of scrap. You're going to have lots of issues in the beginning. The beginning of ramps are always a bit messy, so that's why they're punting it to 2024, which makes sense. So the real question is does Tesla have to make any other moves? It sounds like they've shifted. I think we'll read it later in the article. They've shifted their approach to how to deal with pricing changes.
So more information about the Austin and Berlin factories. Interesting information, this one. Both plants have achieved 5,000 per week, but they're not necessarily going to move towards 10,000 per week anymore, specifically Berlin. So it looks like here that it says here that production ramp in Berlin is straightforward. Producing 24/7 shift, though, is expensive because of the labor laws. And so now they're saying that that Berlin may only do 375,000 units per year as full capacity, instead of, let's say, 10,000 per week would be 500,000 plus. But in Austin, they do think that they might increase it to max out to even 7, 8, or 9,000 units per week. So very interesting information about the capacity of these factories.
Yeah, and they've got to balance their global production plan to minimize their cost structure and then maximize supply locally. So if you think about it, when they were building Berlin during the height of COVID and container costs were $18,000, you know, you make different decisions. But in general, I still think Tesla's supply chain strategy is to localize production and build these bases of production in the areas where they have consumers. But you'll see them, they'll be flexible from time to time because yeah, it may not make sense to have Berlin at 500K if you can get that out of Shanghai and there's no issues with the EU of importing. The cost structure is going to be a lot lower. So there's benefits for them to be able to move supply around and balance there. So this is not uncommon. I think everybody thinks like Tesla puts a plan out. This factory is going to be at 500, therefore it goes to 500, or something's completely broken. Well, no, something could change in terms of cost structure. That would make. I mean, Berlin was never going to be lower cost structure than Shanghai. So if you can import and get your total cost structure lower, they're going to continue to go that route. So this is balancing supply and demand and balancing your COGS globally, not uncommon. I think the other thing with Austin is they're going to turn it into this factory to do the development work for Gen 3, and it's going to have Cybertruck and Model Y. It's going to be extremely busy, and that's still a new facility. So I think that's where the areas of focus are. These things change all the time. I just want everybody to know, like, you can make a 3-year plan or a 5-year plan for your manufacturing footprint, but tactically, inter-year, you're going to balance supply in each factory. You're going to balance your COG structure in each factory. And as things change geopolitically or things change from a COGS perspective geographically, you're going to have to adjust and be nimble.
Okay. I still can't get over the amazing information that we're getting here. So let's talk about Project 3 Highland. Let's break it down. So first of all, they said that they did not comment on the price versus cost dynamic for the new Model 3, but it's industry norm that the new refresh models will see cost improvements. But at the same time, they stepped up the pricing. So, the refresh Model 3 likely costs less to produce and has higher price point, which can help profitability. And this is confirmation, the company does not use gigacasting on the new model. The battery size and cells used are exactly the same as outgoing model. And improved vehicle range comes from aerodynamics and other engineering efforts. The ramp up should be fairly quick, which is what we knew, because the company did not make structural changes to the vehicle like was done with the Model S. The refresh was the result of accumulation of improvement ideas over the past 6 years. So they finally got it done that they've been wanting to do. And then this is interesting. There's no plan to produce Model 3 in Europe, as Giga Berlin primarily focused on Model Y. All Model 3 outside of the United States is produced out of Shanghai, and now only manufacturing and the refresh version with inventory discount taking place for the older model. Right. So yeah, Model 3, thoughts on that?
Yeah. So on Model 3, think of Model 3 as this cup that has to be filled up. And let's say this cup represents 12,000 cars per 12,000 new model refreshes per week. And they're probably at some rate between 1 and 3,000, maybe 4,000. So until they get, again, I don't know exactly, but I imagine if they just started, they're somewhere in that range and they're ramping up. So until they get up to that 12,000 and they fully utilize all the new tooling, remember they bought tooling capacity for this new vehicle, structurally very similar, which allows them to reuse and amortize previous tooling, which is great from a COGS perspective. But there's still new parts. I think there's over 50% of new components. All those parts are, they're many of them are, if they're mechanical, electromechanical, they're tooled up. Those tools need to be fully utilized and get ramped up as well. So until they're running under full utilization, they're running under capacity, which means they cost more per unit, per person or per unit to get out. So long story short, in the beginning of ramp, COGS are a little bit higher. This is branded a Model 3 Plus. And for consumers, and that mindset is like, this is a Model 3 plus other features. It's a better car. It looks new. It's more rare. That, you can't get this yet. It's very difficult to get. So consumers in the beginning of new product cycles are willing to pay a little bit more, especially if they know there's more features and the car's been improved significantly. So this is very smart for Tesla to do. But I believe as they get up to their full run rate per week, the COGS are going to be meaningfully lower, as they kind of hinted in this update, that it's traditional for refreshes to have cost improvements. And I think the costs are going to be meaningfully lower, and they'll be able to take their costs down or maintain, based on the sellout rate of the vehicle, they'll be able to maintain them and garner that margin. So I think they're in a good spot, very normal for what they're doing with pricing early on. And I'll be interested to see, what the orders and the demand look like and their ability to get the full run rate.
Okay, perfect leadway, because now we're going to talk about pricing and cost strategy. This is information that Emmanuel Rosen got from Tesla when you were meeting a couple of weeks ago, and it's very interesting. But here I didn't see anything necessarily, mind-broken. So first of all, this first paragraph, instead of doing headline price reductions, they've been doing these targeted inventory discounts in order to bridge demand gaps for specific trims. And so in specific regions and in specific times, this is the lever they've been doing for 9 months now. So we know that they've been doing that. The pricing strategy, the company's trying to make and sell as many vehicles. So their goal is just to generate free cash flow, and that finances its technology development. And then the interesting point here is that in a normal year, Tesla would be generating a significant amount of free cash flow, but in a challenging year, it is striving for positive free cash flow. So as long as they stay positive while they're still be able to finance all their AI-related new factory capex. So that's their pricing strategy. So if they need to reduce the price in order to sell more. But as long as they have enough free cash flow to fund themselves, that's enough. And then on the cost front, nothing new here. We already said it. The new factories in Berlin and Austin, by far the most cost opportunities at present, will come as production stabilizes. Discounting has been used for Model S and X, but the S and X is only 2% deliveries. And then this is interesting. The R&D and SG&A, which should continue to go down as percentage of sales as sales go up. Right now, it's high because a large portion of R&D is spent on Dojo and Cybertruck, and those will go away once deliveries start in Q4. So it sure looks like that we're right at the middle of kind of that. First of all, it's a down year. And secondly, we got significant investments.
Yeah. So starting from the bottom, a lot of things that Tesla is working on haven't shipped yet. So Dojo just got up into production. Cybertruck has started production, but it hasn't shipped. There's not customers taking delivery of those. So what happens is you're accumulating this R&D spend, and there's nothing to divide it against in terms of product. And so it basically gets put against all of the other shipping product, and it takes your operating margin down. So that's why you've seen Tesla's operating margin come down, because Tesla's actually been ramping up their spend, whether it's buying compute, whether it's this work on the bot, whether it's this, it's all the ramp and pre-material purchases for Cybertruck, all the ramp and purchases for Megapack expansion. All of this is very, very expansionary work that Tesla is doing. Very innovative work too. And so as an investor, this isn't investment advice, but this is where you've got to look at steady state auto companies that aren't doing a lot of innovation. You can name them, right? And they're chugging out, let's take, Toyota, for example, just chugging out product. They can shave their costs down. They can, continue to ship product. Demand is still decent for autos, even though the interest rates are high. So they can optimize their operating margins in this period because they're not pouring all this money into R&D and then all this capital spend that they need to do, for example, for this compute network, which is very expensive. So what Tesla is saying here is till Cybertruck starts shipping, we can actually start flushing all this material out and be able to flush all this, this pre-launch R&D spend, out, and then it goes into more of a maintenance of the line motor or operations mode, it basically goes into something called above gross margin versus below gross margin. In accounting terms, they're going to have all this spend that's basically weighing down their operating margin. So I think the key here is Tesla's innovative. They're spending a lot of money to fund this innovation, and they're going to spend as much as they need to keep free cash flow positive. And so that's how they're working on this clearing price for the vehicles. They want to keep their supply base fully utilized. They want to keep positive free cash flow coming in so they can continue to self-fund. They're all self-funded, these R&D efforts. It's not like a lot of these AI companies that are going out and buying all this compute from NVIDIA, they're going out and raising these huge rounds to get all this money, or they're just going in on debt. And Tesla is, their goal here is to self-fund it through this period. And then just think about this on the other side of it. When interest rates start coming down, not only are interest rates going to start coming down and Tesla can stabilize their pricing, if not even increase it, because the cost of the consumer is going to be that much lower, their demand should go up, and the fruits of all these R&D labors are going to really start bearing fruit. So the timing is really set up well for the future for Tesla.
Okay. We've got so many more topics to cover. We're going to talk Cybertruck, the next gen platform, FSD and Dojo.
Yep.
And I just have to make a comment that every one of these, there's some incredible nugget that they discovered by talking to Tesla that we hadn't heard about yet. So it is worthwhile for us to go through each one of these. Let's talk Cybertruck. Look at this. Cybertruck is on track for start of production deliveries in Q4. So it isn't up to now. This a couple of weeks ago. This is what they told Deutsche Bank. With 250,000 in target annual capacity, Tesla sounded excited for the halo effect on demand for its vehicles. The vehicles are product specific to the US market and will be the only product so far using the 4680 structural pack cells. The company is using 48 volt for electronics as for the first time, as well as 1,000 volt for powertrain. And it's difficult to estimate how many Cybertrucks can be made in 2023 and 2024 because of the vehicle production ramp. They don't know yet, and the 4680s. And then this new technologies could complicate that ramp. But this is good news. I mean, basically, they're still in track for the production deliveries. Anything here that's struck you as interesting?
Yeah, I mean, I think there's a little detail. It's the only product using 4680. Obviously, they've been shipping Model Y with the 4680. So this is why when you look at these reports, not everything verbatim is going to be like, oh, just take it to the bank, it's perfect. But you've got to be able to read and infer from these reports and understand the information that Tesla is trying to reveal or would reveal again to investment bankers. So the Cybertruck thing, I've been talking about this for a while. I said all these vehicles on the road, to me, this is a great sign. These are not hidden vehicles that are going for production delivery, and that's not the case. They're not in mass production until they're out of the production candidate phase. And the phase before that was the release candidate phase. And everybody even thought then, like, oh my God, there's 5 Cybertrucks today. There's 6, they're counting production. That's not production. They need all of these vehicles for all the different test cases they have to run so they can actually get themselves out of the candidate phase and into mass production. And they were very clear to them that both production and deliveries start in Q4, which means at the time of this, note, they're not in mass production yet. So I think we need to, even if Tesla does decide to reveal, that they're out of production candidate phase, I think that's a big milestone, because then they're actually in mass production. So even here in this note, they're guiding for at some point in Q4. So, we don't really actually know exactly when, but I just want to make sure everybody understands the different phases and how much work is ahead. It is a good sign that we're seeing all these Cybertrucks on the road testing, but they're testing. There's software people testing, hardware people testing, reliability people testing. The other thing about the ramp, been pretty clear that, there is a lot of new, unique, and difficult or different things that Tesla is doing that's not only unique to Tesla, but it's unique to the industry. And those things take time to stabilize and ramp from a mass production perspective. And Tesla, rightly, so they called it out. And then coincidentally, we have Tesla taking the Model Y um, standard range all-wheel drive off the configurator, which was taking up 4680 cells. So it seems like all of these things are coming together. And what we really, I think what's really at the core of a lot of this is the 4680 ramp. And then I think you see a lot of people testing these vehicles in the wild, both from an electrical system and software perspective for the new 48 volt architecture and making sure all the timing's right. Because there's system level tests that they can do on benches. They can simulate things in the lab. They can do tons of work to basically say, if you take everything in this system to its edge cases, here's the probability of failure as we get, a million of these on the road. But you also still have to do the drive testing. So I think that there's so many new things in this vehicle. That's one of the reasons you're seeing a lot of drive testing being done. So 48 volt, 4680 ramp, and just all the unique mechanical and electromechanical pieces of this ramp are really, driving the shape of it. So I think they're really trying to downplay expectations too. And, if it's a big hit, then they'll be able to raise expectations later.
Yeah, they have to downplay because it's true. There's so much new technology for the Cybertruck, but as long as we know it's still on track for this quarter for its production and delivery, that's good news. All right, next gen platform is quite interesting. They said that it's the most important hardware project for them right now. It's the largest growth opportunity, potentially supporting 5 million units of annual production across multiple top hats. Now, this is good confirmation here that the next gen platform will be made at all plants around the world, not only in Mexico. Mexico plant will only make the next gen vehicles. So while Mexico has been delayed, it doesn't matter so much because they've already started in Texas, at least the kind of the early plant production line. But then they're going to probably start this across the world as well. Thoughts on that, Jeff?
Yeah, this is how Tesla is basically going to double up from a volume perspective. So this is going to be a massive thing for Tesla, and really for EVs and for transportation. So I like the move. I do like the move of moving early vehicle production to Texas. I've always been a fan of co-locating engineering and early ramp up of our product for superior results. You're trying to take that feedback loop, and you're trying to make it as short as possible between an issue coming up and an issue being resolved. Given the pace of this ramp, if you've got a product you're going to ramp up to 5 million, units annually, you're talking about, massive, weekly production volume. So, I guess 100,000 a week, right? So this is where you want to be able to take that feedback loop between an issue, whether it's a manufacturing issue on the line or whether it's an engineering issue the engineering's got to solve. You want to take that feedback loop and you want to condense it as much as possible, and you want the leadership team over it making quick decisions every day. It doesn't say that you can't move you can't move people to various factories, but when you do that, when companies do that, you are taking your eye off the ball for the next set of products. I don't want to get too far wonky on this, but other big companies, that have this tradition, say I'll name a big company right now in the mobile phone world, for example, one of the biggest manufacturers in the Bay Area. When they send all these people over to China to get something ramped up and built, they actually have they have another development team. They basically work in 2-year skip increments. So, they're the 2023 team that's been doing development since 2020, early 2022. There's another team that's a separate team that's doing the 2024 next cycle product for that phone. And they're different teams and they're different people. And Tesla's not built like that, though. Tesla does not have so much engineering horsepower. I would say so much engineering, the number of people. They don't have that. They're not staffed that way to have 2-year multiple year teams to be able to do this. So this is why it's basically like everything's flowing through almost one effort. Again, I think there's some other R&D efforts in other areas, but this is I don't want to get too far off track there, but this is, I think, a key thing to this
Okay.
vehicle and its time frame.
So lots of very interesting information about FSD pricing and Dojo. So first of all, they said that when they reduced the price reduction from 15,000 to 12,000, they said, we don't know what the right pricing is, right? Because this product's never been offered before. But what they're doing, the pricing on FSD is not set in stone, and it's going to continue to evolve. And their goal is to increase FSD penetration. So offices right now, there's a low attachment rate base at this point, and they're trying to maximize their profit. But they chose to reduce the price from 15 to 20% reduction, and they believe that cost reduction will do a 20% change in adoption. So that was very interesting. What they are saying now, the reason they brought it from 15 to 12, they think they're going to increase the adoption of FSD by 20%. Margins on FSD are close to 100%. And even though the take rate is low, they can use the data collected from the vehicles and learn who the good drivers are. That's what they need. They need more of good driving data. And I think that now explains why they reduced it from 15 to 12. You get 100% take rate. You're going to increase it by 20%. But more importantly, you need more data. You need specifically the good drivers. And Tesla views end-to-end as the only way to solve generalized autonomy. Very interesting kind of confirmation. And they're going to continue to invest billions. And then here, this is interesting. They said it commented that currently NVIDIA is the only company that has the technology to sift through the amount of data it has. With Dojo, the company believes it will have a supercomputer specifically designed for its image and video processing needs. So all of this is jumping up. And in the next episode, we're going to talk about how Tesla actually even announced even more investment in NVIDIA than they just did recently. So thoughts on FSD?
Quick thoughts. I think they're going to, and when they enter a new region for FSD, they're going to keep the cost high so they attract enthusiasts and good solid users to get the data they need. And then as it stabilizes in a new country, they're going to take the cost structure down a bit, or the cost to consumers down. So I think they have a strategy here for global rollout. This 12K, I could see them raising prices again here as the functionality and performance improves. So I don't think they're married to that. I just think they wanted to increase adoption because they actually added that auto steer on city streets. They added it into the package. And I think for this quarter and next quarter and beyond, they want to drive up adoption because it's really stabilizing and it's a good product in the US. So what a great way to drive that up. And they also, I think they're packaging it with the Model S and X cost reductions as well. So you kind of get the full package in that vehicle, which run great. I think a lot of those purchasers of S and X are buying FSD as well. So if you can lower the price on that, lower the price on the S and X together, I think you're going to drive up adoption as well.
Okay, this is my favorite slide. There's so many incredible nuggets here, Jeff. This is the thing I've been waiting for. FSD licensing opportunity. So first one, not great, which is Tesla is enthusiastic about the opportunity to license its FSD technology to other automakers. Believes interest level is high. Okay, that's pretty weak. Interesting. Then they say that they believe that there's few available solutions to OEMs looking for autonomy, including Mobileye, NVIDIA, and Tesla. Automakers will eventually source one of these solutions based on functionality and cost. Okay. Now here's the kicker. They will price its FSD offer to other OEMs so that the customers of these OEMs pay no less than the Tesla customers for the FSD functionality. So they will always make sure that whatever they charge for Tesla's customers, that's what they're going to charge at least to OEMs. And then OEMs would need to make sourcing decisions now in order to be able to launch a future vehicle in 3 years with FSD. So basically they're saying, hey, you don't start now. It's going to take you 3 years. So this whole concept of somebody's going to catch up to us, Tesla is not likely for 3 years. Future Tesla revenue could be several years away.
Yeah. And I've been saying this, it takes a couple of years for integration, right? Because these companies that are working on next generation vehicles, there's usually, call it an 18 to 24 month development cycle. And then they've got to go ramp the product into scale. They got to go into testing, and then they've got to ramp the product and scale. So that's, you're getting into 36 months, 48 months and so forth. And that's why it's kind of a 3-year journey if somebody starts now. So I actually think in the next, again, not investment advice, not any advice, but I think in the next 3 to 6 months, you'll have one or more partnerships announced for Tesla, FSD, Dojo, and the whole system.
Yeah, I agree. I think it's going to happen soon because it's still going to take years for them to implement it. This report was amazing, Jeff. There's so many incredible information. A lot of it is confirmation, but it's still great to have confirmation. And then there's some new nuggets there as well. Thank you, Jeff, for giving us your take on this. Very intelligent, and appreciate you explaining what it is that we saw there. Appreciate this.
Great.
Thanks, Jeff.
Thanks, Herbert.
Hey there, thank you for joining me. If you can, please consider supporting this channel so I can keep it going. It's a lot of work arranging all these amazing interviews. One of the easiest ways is just to click that join button and become a member of the channel. Thank you very much. Let's get brighter.